Three separate warnings collided this week. One from the trade war, one from inside the Federal Reserve, and one from the price of gold and silver itself. And almost everyone watching is treating them as three unrelated headlines. They are not three stories. They are one story told from three different rooms. And if you only understand one piece of it, you are only seeing a third of what is actually coming for your money. I'm going to put all three pieces on the table in front of you, connect them the way almost nobody bothers to. And by the end of this, you will understand something that changes how you read every single one of these headlines for the rest of the year. Here is the twist, and I am giving it to you now instead of making you wait, because it is the thread that ties everything else together. A trade war is not just about the price of imported goods. A trade war is a slow, deliberate machine for creating inflation. And inflation is the single force currently splitting the Federal Reserve down the middle. With some officials now pushing for higher rates instead of the cuts everyone spent all year expecting. And higher rates are supposed to hurt. Yet gold and silver have done the opposite of what the textbook predicts for most of this year. Because underneath the tariffs and underneath the Fed sits a third force, the world's central banks, quietly buying gold at levels not seen in years, treating it as insurance against exactly the kind of instability the other two stories are creating. Tariffs feed the Fed's dilemma. The Fed's dilemma feeds gold. Gold feeds a completely different kind of investor than the ones watching the daily headlines. Once you see that chain, you cannot unsee it, and you will start noticing it in every piece of financial news you read from here forward. Before I go further, I want to know who is actually with me right now. Tell me in the comments where in the world you are watching from. And tell me honestly which of these three stories you had already connected to the other two before clicking on this video. The tariffs, the Fed, or the price of gold. I read these, and I promise you the answers reveal exactly how rare it actually is for someone to see all three pieces at once, which is precisely why this video exists. Let me start with the first piece, the trade war, because it is the part most people think they already understand, and mostly do not. This year has brought a genuinely enormous wave of new tariffs. Not a single announcement, but a rolling series of them. An additional 50% tariff on certain Canadian origin goods is scheduled to take effect on August 19th. A 25% tariff on certain Brazilian goods took effect in late July. Broad new tariffs under trade law now apply to imports from roughly 60 different countries. Layer on top of that the tariffs already sitting on steel, aluminum, and copper. And what you have is not a single tax on a single product. It is a widening web of costs sitting on top of an enormous share of everything the United States imports. And every one of those costs eventually shows up somewhere, either eaten by a company's profit margin or passed along to the person buying the product. In the real world, it is usually some combination of both, and the portion that gets passed along becomes inflation, plain and simple. This is the part almost nobody says out loud clearly enough. A tariff is structurally a tax that raises prices on purpose as a deliberate tool of trade policy. Whether that tool is worth its cost is a genuine, serious debate people can reasonably disagree on. And I am not here to tell you the trade war is right or wrong. What I am here to tell you, plainly, is that a widening trade war and a cooling inflation rate do not typically happen at the same time. And the United States currently has one of the most aggressive tariff regimes in generations, layered directly on top of inflation that was already struggling to come down. That is not a coincidence, colliding with the second piece of this story. It is the direct cause of it. If you are finding this useful already, take a moment to like this video and subscribe, because the next piece is where the trade war stops being an abstract policy story and becomes a story about the interest rate on your own savings and the price of the metal in your own hands. Here is the second piece, and it broke into the open 8 days ago in a way that reversed an entire year of market assumptions. At the end of July, the Federal Reserve met and voted to hold interest rates steady. On the surface, A hold sounds uneventful. Underneath that hold, 3 separate officials on the committee dissented, and their reasoning ran in a direction that should genuinely concern you. They did not want faster cuts to help the economy. They warned, in language unusually blunt for people trained to hedge every sentence, that waiting too long to act now risks forcing a far more aggressive and painful round of tightening later. 3 of the most informed people in American monetary policy are telling you on the record that the danger right now is not that the Fed is moving too aggressively. It is that inflation, fed in part by exactly the tariff wave I just walked you through, is not under control the way markets spent all year assuming it was. That dissent flipped the market's own pricing. Almost overnight, for most of this year, the dominant expectation was rate cuts. Today, the probability being priced for a rate hike as soon as next month sits at roughly 2 out of 3. Tomorrow morning, the government releases the July jobs report, the single data point most likely to either confirm or scramble that entire repricing within hours. This is not a distant abstract event. It lands tomorrow, and it will move every market I am talking about in this video before the day is over. Now here's where the third piece comes in, and it is the part that resolves what should otherwise be a contradiction. Higher rates are supposed to be bad for gold, because gold pays no interest, and cash suddenly pays more, just for waiting. That relationship held for a real portion of this year, which is part of why gold sits meaningfully below the record. High it set back in January, even after a year full of headlines that should have favored it. But at the exact same time, hike expectations were building. The world central banks did not slow their gold buying. They accelerated it, purchasing gold in the most recent quarter at a pace roughly 74% higher than the same quarter 1 year earlier. Understand what that means. The force that is supposed to make gold weaker intensified. And the buyers who move more money in this market than any hedge fund or retail investor combined did not pull back. They leaned in harder. The reason is that central banks are not trading gold the way a fast money trader does. They are not betting on tomorrow's jobs number or next month's Fed decision. They are converting a portion of national reserves slowly and deliberately away from paper promises and toward an asset that cannot be frozen by a foreign government, cannot be defaulted on, and cannot be inflated away by anyone printing more of it. A widening trade war and a fractured, dissenting Federal Reserve are exactly the kind of instability that makes that kind of insurance more valuable, not less, regardless of what happens to the interest rate this quarter or next. There is a number sitting underneath all 3 of these pieces that ties them together, even tighter. And it is one almost nobody mentions when discussing tariffs or the Fed separately. The United States government's annual interest payment on its own debt has now crossed $1 trillion a year. Just the interest every year. That creates a brutal bind directly beneath everything I have described. The more aggressively the Fed fights the inflation that tariffs are helping to create, the more expensive the government's own debt becomes to service, which puts a real ceiling on how far and how long rates can climb before the interest bill itself becomes politically unbearable. Tariffs push inflation up. Inflation pushes the Fed toward higher rates. Higher rates collide with a $1 trillion interest bill. The government cannot easily absorb, and gold, an asset that answers to none of those pressures, sits at the center of all of it as the one thing central banks are turning to precisely because they can see this exact collision building in slow motion. Let me make this real with 2 people, because none of this matters until you see how it lands in an actual life. Neither is real, but both are the kind of person you might recognize. The first I will call Marvin, 69, who has spent the year reading each of these stories completely separately. He reads a tariff headline and thinks about the price of the truck he wants to buy next year. He reads a Fed headline and thinks about the interest rate on his savings account. He reads a gold headline and thinks about a shiny metal that has nothing to do with either of the other 2 stories. Marvin is not unintelligent. He simply never had anyone connect the 3 dots for him. So each story lives in its own separate box in his mind. and his plan for his own retirement savings has never accounted for the fact that all three boxes are actually one machine quietly working on the same outcome from three different directions at once. The second person, I will call Corinne, 67, and she is not wealthier than Marvin, and she is not a professional analyst. She simply started asking a single question a while back. Whenever a new tariff or a new Fed statement crossed her feed, what does this actually do to prices? And what does that do to the Fed? And what does that do to the asset? The world's most informed institutions are already accumulating. When the descent hit 8 days ago and the market's assumptions flipped overnight, Corinne was not surprised because she had already been watching the tariff wave build the inflation pressure that made that descent almost inevitable. Marvin had to scramble to understand a headline that, to him, seemed to come out of nowhere. Corinne watched the same headline confirm a pattern she had already been tracking for months. The difference between them was never intelligence, and it was never luck. It was that one of them saw three separate headlines, and one of them saw a single mechanism wearing three different disguises. Now, why do so many careful, intelligent people end up like Marvin, treating trade policy, monetary policy, and precious metals as three unrelated beats on the evening news? Part of it is simply how modern financial media is structured, with a trade reporter, a Fed reporter, and a commodities reporter, each covering their own narrow lane, rarely stepping back to connect the dots between them. The human mind naturally mirrors the categories. It is fed. If the information arrives in three separate boxes, it tends to stay filed in three separate boxes, even when the underlying reality does not respect those boundaries at all. The investors who consistently see these moves coming are rarely smarter in any general sense. They are simply willing to do the unglamorous work of connecting categories that the news cycle insists on keeping apart. There is a historical echo worth sitting with here, because this exact combination, aggressive tariffs, colliding with a central bank fighting inflation, has happened before, and it did not go quietly. Go back to the 1970s, a decade that combined external price shocks with a Federal Reserve that spent years moving too cautiously, worried about hurting growth, hoping inflation would fade on its own before eventually being forced into a dramatically more painful round of tightening to finally break it. The lesson from that decade is not that today is a repeat of it, because history never repeats exactly. The lesson is that when a real cost shock, then it was oil. Today, it includes a widening tariff regime collides with a central bank that has been reluctant to act early. The eventual correction tends to be larger and more painful than it would have been if action had come sooner. Three officials inside the Fed appear to be channeling exactly that lesson right now, in public, on the record, whether the rest of the committee agrees with them yet or not. Now, let me be careful and honest with you, because I will not insult you with fear. And this exact combination of stories draws people who want to frighten you into a rushed decision. None of this guarantees a rate hike arrives next month. Tomorrow's jobs report could easily come in soft and push the Fed right back toward patience within hours. None of this guarantees tariffs stay at their current scope. Trade negotiations shift constantly, and rates on any given country's goods can be adjusted, delayed, or reversed with a single executive action. And none of this guarantees gold or silver do anything specific in any specific time frame. Gold remains a genuinely volatile asset, still meaningfully below its January peak. And anyone promising you certainty about where any of these three threads land is selling you something you should be suspicious of. What I am giving you is not a prediction of tomorrow's number or next month's decision. It is the mechanism connecting all three stories, so that whichever way any single piece breaks, you understand why your money is moving, instead of reacting to one headline at a time with no sense of how it fits into the larger picture. I want to say a word about silver here specifically, because it sits inside this same three-part story, but carries an extra dimension gold does not. Silver is both a monetary metal, held the same way gold is held, and a heavily consumed industrial material used in solar panels, electronics, and a widening range of manufacturing that does not care what happens at the Fed or in a trade negotiation. That industrial floor under demand is part of why silver has surged so dramatically over the past year, even through a brutal correction along the way. Layer the tariff story, the Fed story, and the central bank buying story on top of that industrial backbone. And you understand why silver tends to move further and faster than gold in both directions whenever these three forces align, which is exactly what is happening right now. So let us pull this together and go back to the three warnings we started with. A widening trade war is pushing costs higher across an enormous share of what America imports, feeding directly into the inflation problem sitting underneath everything else. That inflation problem split the Federal Reserve 8 days ago, with three officials warning that waiting too long to respond risks a far more painful correction later. And the market has already repriced toward a real chance of a hike rather than a cut, with tomorrow's jobs report standing as the next major test of that repricing. And gold and silver, instead of simply falling the way higher rate expectations would predict, are being bought by the most patient, most informed buyers in the entire financial system at an accelerating pace. Because the deeper story here is not any single tariff or any single Fed meeting. It is a $1 trillion interest bill and a widening web of trade costs that central banks see building in slow motion, far more clearly than most individual investors ever get shown. Here is what I want you to carry away from this, stated as plainly as I know how. This is not a call to panic, and it is not a call to make any sudden move based on a single headline, because balance and patience matter, especially for anyone near or already in retirement. It is a call to stop reading tariffs, the Fed, and gold as three separate stories, because they never were, and understanding the chain between them is worth far more than reacting to whichever one crosses your feed today. Whether a modest, deliberate allocation to gold or silver belongs in your own plan depends entirely on your own circumstances, your own timeline, and your own comfort with volatility. And I am not here to tell you the number. I am here to make sure that the next time a tariff headline, a Fed headline, and a gold headline all cross your screen in the same week, you see them as the single connected story they actually are. Do not let anyone use this moment to rush you into a costly decision, because there will be people trying, and they get louder every time these three stories collide the way they just did this week. And do not dismiss any single piece of it either. Telling yourself a trade dispute on the other side of the world or a single dissenting vote inside a room in Washington could not possibly reach your own retirement account, because you just watched in real time exactly how directly all three of them do. Those are two different mistakes, and the sensible path sits calmly between them. None of this is financial advice. Every figure I have referenced, the scope and timing of this year's tariffs, the three dissenting Fed votes, the hike probability, the central bank gold purchase figures, the $1 trillion interest expense comes directly from official trade notices, the Federal Reserve's own statements, and the World Gold Council's published reporting. So you can verify every word of it yourself rather than take mine. I opened by telling you that three separate warnings collided this week, and that if you only understood one of them, you were only seeing a third of what is coming for your money. Now you understand exactly how they connect: tariffs feeding inflation, inflation fracturing the Fed, and a fractured Fed pushing the world's most patient buyers deeper into gold, all at the same time, all part of the same machine. So let me leave you with the question underneath all of it. Now that you can see all three pieces moving together instead of three separate headlines, when the next one crosses your screen, are you going to read it the old way? Or are you finally going to see the whole picture, the way the people already positioned for it clearly can?